Hi, Iris. Iris, I'm assuming you can see me and hear me. If you're on the computer, move your mouse around on the screen, and if you want to unmute yourself, you can. If I can unmute you. There might be a pop-up that comes up.
I'm here.
Hey, Diana. How are you?
I'm good.
Hi, Kim.
Hello.
Iris, I see your message. Understood. Your computer may not have a speaker on it or a mic on it for that. Hello, Ricky.
Keith, am I muted?
Kim, you're not muted, but I can mute you if I want to.
Because I'm driving, so I don't want you to hear background noise.
All right, so I'll mute you.
Okay, thanks.
Yeah, when we get started, I'll mute you. All right, so your speakers work, Iris, but maybe the computer doesn't have a mic. Either way, it doesn't matter. And I keep clicking through. Rick, can you unmute yourself and help me out with something here? When I click through here, what do you see on your screen? Just your name?
I'm just seeing you
Okay, good. All right.
by the mountains.
All right, good. I can't see me for some reason. Whatever. I'm gonna get started in a minute. We had two other people who said they would be on here. Hey, Nick. Hi, Janet. I'm gonna mute Kim. I'm gonna mute you now. Drive safe.
Okay.
I'll get this slide out. I'll get these slides out to you later on. Rick, do you see? And just lost my share.
We could see your slides for a second there, and then they,
What happened? I'm gonna try that again. All right, almost there, folks. Hi, Mel.
Hey Keith, how's it going?
Good. As long as I can
Good.
get my presentation up, we'll be good. Just going now.
Okay.
Rick, can you see the slides?
no, blanks. Yeah, now we can.
All right, good.
Yep, I can see it as well.
All right, good. Thanks, Mel. For those of you that are new, I'm not gonna take questions. Just try to keep this to 20 minutes and then we'll do a Q&A afterwards. So, take notes real quick and then we can always go back to stuff. I'm gonna try this. All right, so it's not letting me do what I want to do. That's all right. Rick, can you still hear me? Sorry, folks. Rick, can you hear me?
Yeah, we can still hear you.
Can anybody hear me?
I can hear you.
I can hear you.
I'm not sure what happened to my speakers now. You can hear me, okay. I can't hear anybody else though. That's not good.
Maybe because you muted it. Did you mute everybody?
All right, I'll just keep going then, and then we'll try to figure out the my own speaker issue. Okay, I'm gonna try to share that screen again. I'm sorry,
Keith, it's
everybody.
Shannon. Can you hear me?
Okay, here we go. Yep, we'll drop questions in the chat. All right, thanks a lot, Mel. I can move forward on the screen. All right, maybe it's gonna go slow, but 4 ways to bridge the gap. We're gonna cover less than 20% down, no PMI, and leveraging assets at the end. Why are we even talking about this? When you're talking with buyers and or sellers, less sellers, but more buyers, we need to be talking about, and I have this conversation with every client that I talk to, the simple law of demand and supply. I say supply and demand. We all know, I don't need to read this whole thing, but the lesser supply, the greater the demand. And so that demand has created a frenzy. And so buyers need to be well informed about why we even need to address this. Why do we need to address an appraisal gap? It's not because sellers are greedy. It's not that anybody's trying to take advantage of anybody. It's just that as multiple people are making offers, which is, again, this is a unique time in our industry right now for the last 2 or 3 years. Buyers just need to be informed of the fact that there's limited inventory and they need to put this in perspective. So while prices get driven up through multiple offers, appraisers struggle with determining a value on that house when historical data, the last 3 to 6 months of the appraisal values, may not have kept up with the actual demand. But buyers need to be aware that even though they are paying more than the list price, that's still likely the market value. That's simply how supply and demand works right now. So we're going to use $500,000 as a list price for the example. As we go through that, we're going to use $600,000 as an offer. And as we go through these options, I want to remind you, we're talking about this first part in a way that we're trying to win a bid. This is about convincing a seller to take our offer when you're making that offer. We will get to how does this impact the buyer, but if we don't put first things first, if we don't win the bid, we don't even get to have that second conversation about how it's going to affect them. So we are going to go over how this affects buyers' finances. We're just not doing that yet. I'll get to that as we go through those slides. We have to win the bid first. Okay. So we're going to bridge the gap down to the list price. Probably the most common that I've seen. If you offer to bridge the gap of $100,000, that's from 600 down to 500. Again, that would be the most common. It almost seems like the most obvious. And when I talk to buyers, they feel like when they're talking about bridging the gap, they feel like they have to bridge the entire gap. That's the first impression. I say that, I know that because I've talked to buyers and they'll say, I don't have $100,000 to bridge the gap. I guess I can't compete. I guess I can't make an offer. So if you know this, you can correct them on this point, because you could do a partial bridge of a gap. So in this instance, or in this example, and I should have spelled this out, but let's say the buyer, so the difference between 600 and 500 is 100,000, but let's say they only have an extra 50,000 to work with. They could offer this first line: buyer will pay $50,000 over the appraised value, not to exceed the total price of 600,000. So if they were to offer that, if the house appraises for 525, they're still guaranteeing the seller 575. And this, as I've already skipped ahead here, they're guaranteeing the seller a price of 575. The buyer and seller, and the seller doesn't want to be in a position to renegotiate after the appraisal comes in, which is why we have to bridge this gap. It has to be spelled out and defined. And when I say it has to be, keep in mind, we're talking about examples where there are multiple offers. If there are no other offers and you're negotiating one-on-one or directly with the seller, that's going to be a different discussion. But we're talking in this market about multiple offers. And so you can convince the seller, hey, you won't have to renegotiate. Now, in this example, this seller's guaranteed, again, we don't know the appraised value, but let's say at 500,000, if that's what the appraised value came in at. I know I'm getting away from the script here, but they'd be guaranteed $550,000. And I didn't spell this out, but let's think about this for a moment. They're guaranteed $550,000. Let's say someone else came with an offer and their offer is $550,000 as well, and they're bridging the gap. The seller would be better off taking the 550 guaranteed, with a chance of accepting that offer at 600, with a chance that the house appraises for 510 or 525 in this example. So even if the house just appraised for 525, they're still going to get 575. I've seen, or I've heard of, if I'm talking to a seller, sellers aren't going to walk away from the money because I'm going to explain this to them, but I've heard of scenarios and I've seen it happening where the seller was going to walk away from a $600,000 offer because they weren't offering to bridge the whole gap, but yet the buyer was still offering to bridge a big chunk of the gap. And so they could have conceivably left money on the table. I'm going to call this next piece the excess bridge. So we've already discussed an offer of 600,000 with a list price of 500,000. And again, if we go back to that first bullet point, where the most common thought is you've got to bridge the gap. So the average person that can bridge the gap down to 500, this excessive bridge or excess bridge, if they have surplus funds, a buyer may say, we'll bridge the gap as long as the house appraises for 475. Now, this is really just a selling point to try to drive the point home. If everybody offered 600,000 and offered 100,000 to bridge the gap, and your client is the one offering to bridge the gap even lower than the list price, just think what the message that's going to send to the seller. That becomes a no-brainer to the seller. I rarely ever see this tactic used, but it has been used, and we've helped clients win bids just by throwing that little extra in. It could be 5,000 or 10,000 under list. Now, again, everything comes with a degree of risk. Think about this for a moment. This is an example where the buyer and their agent, perhaps you're advising them that it's highly, highly unlikely that the house listed at 500, it won't at least appraise for 500. So this buyer is willing to take that chance and just drive the message home to the seller. Hey, I'm buying your house. I'm going to do my best, put my best foot forward. And this will edge out offers. And I'm speaking from experience. Some of you on the call may have done this as well. And again, think about everything we do when we're presenting an offer. The whole goal is to sell the seller. We're selling the seller and their agent to take your offer. So any little edge we can find, we want to utilize that if we can. Now, that option, that option is only if they don't have enough money to just say, hey, we're gonna do a full appraisal waiver. The full appraisal waiver could be that the buyer has cash, can pay cash for the house. That would be the extreme example. But that would be the best example. If the buyer has cash, it wouldn't matter what the house appraises for, they're still gonna pay, they're still gonna buy the house. But an example here where there's $600,000 on a price of a home, listed at 500, if that buyer has at least $300,000, they know they could comfortably waive that appraisal. That's the buyer buying regardless. And then the other way to do a full appraisal waiver is by us, the lender. When I say us, me, Rick is on the call as well. Us as the lender, we can do some work ahead of time and figure out whether or not we actually need an appraisal. We may not actually need an appraisal for this particular home, and that's a lender appraisal waiver. So there's two different ways to do a full appraisal waiver, A and B here. The buyer just has enough money to confidently say, we're going to waive the appraisal value altogether. We're going to buy the house regardless of what it appraises for, and then a lender appraisal waiver. Now, keep your notes. We'll get back to that. I hope I get my speaker working. All right, now let's talk about the impact of this. So hopefully those 4 points or those 4 ways, hopefully I shared at least one new thing there, one different way to do it. Everything's about gaining an edge today. Now, I want to talk about less than 20% down. So I'm going to use that same $600,000, and I'm going to go through this quick. If you get lost, I want you to just understand the very last concept. I'm going to start with the last concept, actually. Price of $600,000 in all 3 scenarios, and the house appraises for $600,000. Then we don't really need to do anything different with the loan. But if the house appraises for $540, I did 2 different scenarios here with PMI. If the house underappraises by 10% of the offer price, $540, I can work out a loan scenario where they include monthly PMI. It's only $52. And the payment difference from our very first scenario with 20% down, that's only an increase of $52. When I go over this with somebody and they recognize that they can reallocate funds, first $60,000 in this scenario, the first $60,000 in scenario 2 would go towards bridging the gap, because you've got a gap between the appraised value and the price. So the first $60,000 of their 120 is going to go towards bridging the gap. The second 60,000, that's the amount left over from the original 120. That second 60,000 is what's going to go towards the loan. And so the first 60, I'm calling that the first 10%. This 60, I'm calling the second 10%. Technically, if you take 60,000 divided by 540 as your loan amount, technically you get 11.1%. But we're just going to round it at 10% just for the concept. But for somebody that wants to check my math later, I threw this in here. So, in the chat, did anybody really know that it could be that? That's a negligible difference. And if I'm in this price range, 600,000 to between 500 and 600,000, when I tell a buyer that they could bridge the gap in this fashion and really only end up putting 10% down towards their loan, they have no idea. They're blown away when I tell them the PMI is only going to be $52 a month in that scenario. Many people, majority of people still think PMI on a monthly basis is at least $100 to $200 to $300 because their parents are telling them that, their aunts and uncles are telling them that, or that's what their experience was 10, 15, 20, 30 years ago. Another scenario, again, reallocating funds, there's PMI buyout. It's a one-time buyout. Here's what I did in this scenario. I still used this $120,000. We put the first 60 towards the bridging of the gap because we had to. The second 60, we still established a $480,000 loan, but then on top of that loan, I rolled in a one-time fee, $25.57. For some reason, I copied my math wrong. This should be $482,557. So I've increased this loan amount by $2,500, but I have no PMI. And this payment is now only $17 more a month than this original loan scenario with 20% down, $600,000 price, $600,000 appraised value. This was their target payment. We've actually brought that within $17. If I blew people's minds away with this one when I'm talking to them buyers, this knocks their socks off as well. Now, the other thing I want to show you here, the funds needed to close. I've showed you we've used the same $120,000 in each and every one of these scenarios. We've just split that money up differently. We've reallocated the funds. They didn't need any more money. We're accomplishing all this with them still using the same amount of money. If they knock their socks off, I don't know what else we get. I don't know how else to impress them, but they're using the same amount of money here. I'm off by, it's a difference of $4 if you're actually paying close attention. $133,540 versus $544. I got this as close as I could in this example. So there is a way to bridge a gap comfortably and offer to bridge a gap without having to spend any more money. I would say that this is probably the number one mistake or oversight, or just people just don't know that this is an option that to explore to keep their payment where they originally wanted it to be. Most everybody thinks when they talk about bridging the gap, and you'll hear it over and over again. Most consumers think when you talk about bridging the gap, they're thinking they've got 20% down plus whatever the gap is. They have to come up with even more than 120,000. Couldn't be further from the truth. They don't have to. I will say emphatically, they don't have to come up with any more money in a scenario like this. Now, keep in mind, I used 10% down as a scenario. If they're only off by 5%, this PMI would be even lower. This monthly cost would be even, or this one-time buyout would be even lower if we're doing at least 15% down and they're only bridging a 5% gap. Of course, if they're only, I've done this where they had to use 15% to bridge the gap, and we still worked these numbers in and kept these payments close. And 15% of their original down payment went towards bridging the gap, and they ended up with a 5% down mortgage scenario. But in the end, the final loan amount still ends up being the same. Can't lose track of that. Last couple things. Leverage assets and show proof of funds. I'm just adding this in here as part of the negotiation piece. In all cases, you should show proof of funds. If you're talking about, even if you're not talking about leveraging, or talking about bridging the appraisal gap, we have a lot of success. And every time I make an offer, pardon me, every time a client of mine makes an offer and you're presenting an offer, Rick and or we're following up with the listing agent. Very often they're asking for proof of funds. In my opinion, they should never be asking for proof of funds because you should be showing it right off the bat. Our job is to sell the seller. What better way to sell the seller than to put their mind at ease sooner rather than later? It's all part of making that best first impression. Make the best first impression. This is just an example, one example of what we do. So in the pre-approval letter, I jumped ahead a little bit here. Here's an example. I'm doing a screenshot. I'm adding it to the second page of the pre-approval. This gentleman redacted the names. Normally, I will leave the client's names in, but for this purpose, I didn't leave any personal information in, but you get the idea. In this scenario, and it doesn't matter, I've shown $1 million for some people just so the seller knows they can perform. We're making a statement by suggesting that. I skipped ahead a little bit. When you're a seller and you're reviewing offers, you should, in my opinion, you should be asking for proof of funds. So many deals fall apart. Deals still fall apart today. They do. You all know it. Deals fall apart. They shouldn't. Because a buyer can't perform, that should not happen in this market. And so that's something, now if you're going back to representing a buyer, when you're talking to your buyer, remind them the number one goal is to win the bid, or let's get an agreement with that. And then are they or their bank or their broker, are they doing all they can to help your buyer increase their chances of winning the bid? If they are not, this is where it's an easy segue. If their bank is not doing what we're doing for them right now, it's an easy segue for you. Hey, I'm going to have Keith give you a call. I'm going to have Rick give you a call. We've got to make your pre-approval look better because we need to win the bid, right? Yes. Guaranteed rate difference. Through our process, we're already getting all this stuff. We're prepping every buyer who will listen to us. We're prepping them for our pre-approval, asking them for assets. We already get this stuff up front. It's a big difference. And then we're also doing our power bid, the fully written approval. So just by plugging into our normal process, we're already going to have this information. Shouldn't be asking for it as an offer is going in. It's something that should be documented up front. I also want to share some quick food for thought, something that I'm hearing still. Let's work with what we know to be true today. I'm talking about our opinions. I've been guilty of this early on. I stopped. Are folks overpaying for homes today? We've been having this discussion for 2 years. No, they're not. 2 years ago, if we suggested they were overpaying or somebody said they were overpaying, well, they made a huge mistake because homes cost more today. What's your opinion? Blunt or candidly, I would suggest you be careful with what your opinion is, because what if your opinion is wrong? If you're inclined to think prices will level off or self-correct, and you reinforce for them that they might want to wait or not overpay, your opinion could also cost the client money. If you're somebody that told somebody a year or 2 years ago, let's wait for homes to level off, don't pay this much for a house, you may have cost that person money if you actually gave that advice and they sat on the sidelines. So just be careful. Work with what you know to be true today. Homes are in huge demand. There's limited inventory. Let's do our best to win this bid if you want to own a home. All right, that's all I've got on this 25-minute mark. And I see some chats. Are there any legal considerations that real estate agents need to be aware of when discussing appraisal gaps with potential clients? Mel, good question. I had no idea. Wow, thanks for that first comment. Good question, Mel. This is an area. So everything that I've gone over here, I am strongly, strongly urging you to not go over this stuff with a buyer. You are not in the position to do it because you may misrepresent what I just explained to you. You are not licensed to or educated on these topics. So Mel, you're never going to be in that position by suggesting that you talk to an expert. That's not your role. And all of you, that's not your role. Your role is to know, all right, Kim, see ya. Your role is to know that there are options that the buyer needs to explore. If they don't explore the options, they may be missing out on an opportunity to win a bid or improve their chances. Mel, I hope that helps. I'm really disappointed that my speakers are not working. I don't know what happened there. Any other questions? Any other questions on the topics? If you have a specific scenario, by all means, give me a call. But I do hope this was helpful. Somebody give me a thumbs up or something in the chat. Bob, I can actually see you. Yeah. Okay. All right, so you logged in as well. Any other questions on these? I'll get these slides out. This presentation is going to go up on my YouTube channel. I'm working on getting that a little bit more accessible for everybody and easier for me to get out. Thanks for tuning in. Nick, I see thumbs up. Thank you. Does it matter if it's an FHA or conventional? Great question, Iris. It does matter. The scenarios I was going over primarily were conventional loans. Think about an FHA loan for a moment, however. An FHA loan, it's unlikely a buyer is putting 20% down to begin with. But if a person with an FHA loan does have enough money to bridge a gap, then by all means, they should be offering to bridge the gap. The way we structure the loan, we're just going to have a different conversation about that. An FHA loan, for those that don't know it, it doesn't matter how much money you put down on an FHA loan. You could put 50% down. You're still going to pay PMI for 11 years on a 30-year fixed rate loan. That's a little known fact. It is a fact, though. You'll still pay PMI. So there's no way to get rid of PMI on an FHA loan. But if a buyer is pursuing an FHA loan, they're already conditioned to the fact they're going to be paying PMI. But the 4 ways, so the first part, though, the first part still holds true as to how much of the gap they're willing to bridge. Any other questions? I'll stay on another 30 seconds. And if you're done, by all means, log off. I won't be offended. If you don't have any questions, you're welcome, Jan, and see ya. Linda, see ya. Thank you. I'll get this out. All right, I think we're wrapping up unless there's another question. If I close this and we end this, you've got a question, text me, I'll give you a call. Mel, see you later. Thanks, everybody. Thanks for dealing with the technical issue and me not being able to hear you all, but glad the chat works. Thanks. All right, you're all
Thank
looking,
you.
even though I still can't see you. Bye, everybody.
Thanks.